Good morning, everyone. Thank you for joining us today and welcome to our webinar on M&A and Private Equity, hot topics in corporate and tax. My name is Florence Colpaert. I'm a counsel in our corporate and M&A team, and I will be your host today together with my colleague Geert de Neef, who is a partner in our tax team. Perhaps a few housekeeping matters before we start. You will find the presentation that you see on the screen. You can download it on the right-hand side of your screen under handouts, so don't hesitate to do that. You will also receive after the webinar a certificate from GoToWebinar, our platform, so that will happen automatically. And then finally, but also most importantly, you can, of course, ask questions throughout the webinar by using the chat function or the feedback form. You can also, of course, if you have questions after the webinar, contact us by email. We will try to answer the questions still at the end of the webinar, and otherwise we will answer them by email after the webinar. So let's get started. What is on the agenda today? So I will handle the corporate topics in M&A and private equity, and then afterwards my colleague Geert de Neef will handle the tax topics. So the corporate hot topics that we will talk about today are, on the first hand, the new Belgian framework for foreign direct investments, which is due to enter into force at the end of this month on the 1st of July. And that will definitely have a major impact on foreign investments in Belgium. Then we will tackle an entirely different topic, the impact of ESG on M&A and due diligence. And then Geert will handle the tax topics, especially recent ruling on corporate control structuring, also recent jurisprudence in terms of private equity and structuring. And then, of course, last but not least, the ongoing tax reform, what is contemplated, when will it happen? Geert will brief you on all of it, of course. So let's start with our corporate topics, and more specifically, the Belgian framework on foreign direct investments, or FDI. So what is FDI and where does it come from? So we have a European FDI regulation of 2019. The purpose is to safeguard the security or the public order in the European Union. So what is the regulation targeting? It's targeting any investment by a foreign investor which aims at establishing or maintaining a lasting and direct link between such foreign investor and the EU target company in order to carry out an economic activity in a member state. So when we say any type of investment, it means that it will apply to greenfield investments, so setting up a new company, starting a new business in the EU, and it will also apply to M&A, so acquisition of companies or investment in existing businesses or companies in the EU. So it is rather broad. It all started with that European regulation. Then how was it implemented in Belgium? Well, on 1st of June 2022, a Belgian cooperation agreement was reached between the federal entity and the various federated entities. And what does that cooperation agreement aim at? It implements a mechanism for the screening of the foreign direct investments that we just talked about. So in terms of timeline, that cooperation agreement was signed last year, but it still needs to be adopted by the various parliaments, federal and of the federated entities. This is expected to take place around the 1st of July, so that would be the entry into force as well of the Belgian legislation, but it's possible that it will still be delayed with a few months. So let's see. So what are the transactions that will be covered by that new Belgian FDI? legislation. So as I said, any form of investment in a legal entity in Belgium, and that includes indirect investments. So for example, if a foreign investor, meaning a non-EU investor, would invest or acquire a holding company in Germany, and that holding company has a participation in Belgium, the Belgian FDI legislation will apply to that investment or that acquisition. It also means that if a foreign investor invests in a Belgian company, the Belgian FDI regulation will apply. But if that Belgian company has a subsidiary in France, for example, the French FDI regulation will also apply. So it means you will have to look really, if you have an investor from outside the EU, you will have to carefully look at what are the, where's the business of the target, where is it located, and you will need to look at the various legislations. So what do we mean when we talk about a foreign investor? So it can be a natural person, then the person would have to have its primary residence outside of the EU. It can be also a legal entity, of course. Then we will look at the registered office or the principal activities of that legal entity. But we will also look at where the ultimate beneficial owners of that legal entity are located. Where do they have their primary residence? So if you have a German company investing in Belgium, you would think no problem, it's not outside of the EU. But if the ultimate beneficial owner is, for example, a Chinese person, then the Belgian FDI legislation will apply as well. So you see that the scope is very broad. What are we looking at? We're looking at transactions that will have a possible implication for national security, public order, or the strategic interest of the federated entity. So that's the core principle. And as I said, it will apply as from the 1st of July. You will see that there's a bit of a nuance there, but in principle, the entry into force will be the 1st of July. So the transactions signed, not closed, before the 1st of July. So we're not going to look at any investment, because if it would be a minimal investment, then there would be no threat to national security, etc. So there are two thresholds that will apply. The first one is relates to activities in various sectors. So on the left-hand side, critical infrastructure, technologies essential for the safety or the military equipment, supply for critical inputs like energy or raw materials, access to sensitive information, private security, and freedom and pluralism of the media. So if the investment is made in a business that has activities in those sectors, then the threshold of 25% or more of the voting rights will apply. So there will be no FDI legislation applicable below that threshold. If the activities are in the sector of technologies of strategic interest in the biotech sector, then there's an additional threshold of the target having a turnover of more than 25 million in the last financial year. For the activities on the right-hand side, so in the business of biotech, defense, cybersecurity, energy, electronic communications, and digital infrastructure, the threshold is lower. So we will look at deals where the foreign investor is acquiring more than 10% of the voting rights, and the turnover of the target exceeds 100 million euros in the last financial year. So the first exercise will be, of course, when you're contemplating such an investment, will be to determine if you fall within the criteria, of course. Then what does the Belgian legislation aim at? It will create an interfederal screening commission. And it's that screening commission which is composed of representatives of the federal and the federated entities that will, let's say, look at the investment. So first step, once you have identified that you fall within the criteria, which I'm aware, let's look maybe just quickly again at the activities. Some of these activities are not entirely clear, so the practice will need to determine which activities are really aimed at, I would suggest, if you are in doubt, of course, and that perhaps you decide to do notification anyway. So that's the first step. Once you have identified that you do fall within the criteria, or you may fall within the criteria, then the foreign investor has to submit the transaction documents to the screening commission, and that has to happen between signing and closing. And so because the transaction documents will need to be submitted to the commission, you need to have already a signed document, but you cannot close the deal as long as this procedure is ongoing. So that's quite important. We'll talk about that later. It will have an important impact on the deal timeline. So the foreign investor files the transaction documents. It will have to, amongst others, mention the ownership structure of the investor, of the target, what are the activities of the investor, of the target, what is the deal value, how will the deal be financed, things like that. Then, as from that moment, start an assessment period. So the screening commission will then assess whether there's a risk for public order, security, or strategic interest, and that's for a period of 40 days, 40 calendar days. So your deal will be on hold for that period. So it's 40 days, but if the commission is asking for additional documents, that period will be extended. But that's a fixed period. If at the end of that period there is no decision yet by the screening commission, the deal is approved. So that's good news. If during the assessment period the commission has established that there is a risk for public order, security, or strategic interest, then comes a screening period, a formal screening. So the identified risk will be further screened, and the commission will then make a decision. So either it will approve the transaction or refuse it. It can also take a sort of in-between decision to impose corrective measures, meaning, for example, imposing certain procedures for exchange of information between the target and the foreign investor, asking for security clearance of certain directors, asking for some divestment measures or some reporting to the Belgian authorities, so that the commission can also impose certain corrective measures. That last period of screening has no fixed timeline. So for the assessment period, you have a fixed period of 40 days, and if there's no answer, the deal is approved. But for the screening, it's an open-ended. So you feel already there that this can be an issue in terms of deal certainty and timing. If the commission then refuses to approve the transaction, then there is an appeal that is possible within the Court of Appeal. There are, of course, sanctions, fines between 10 and 30% of the deal value. So that can be quite high, of course. These fines will apply basically if the procedure is not complied with. So either you didn't notify, and you should have, or you're providing misleading or incorrect information, or if corrective measures have been imposed, that you're not implementing them correctly. Finally, and also quite importantly, so we talked about the whole process where the foreign investor itself is notifying the deal to the screening commission, but the screening commission can also, at its own initiative, start an assessment and then screening procedure, including imposing structural modifications to a deal or corrective measures. And that's the tricky part, is that this can happen up to 2 years after the acquisition, or even up to 5 years if there is bad faith. But it also means that despite the fact that the Belgian legislation will only enter into force, let's say on the 1st of July, the Commission, in theory, can still assess and screen deals that were signed 2 years before the entry into force. So let's see how that will develop, but that's an important element as well. So what will be the M&A implications of this new legislation? Well, we talked about it. Obviously, the deal timeline, you cannot close the deal before the screening commission gave its green light. So we expect that there will be more split signing and closing than before. It's obviously a disadvantage for the foreign investors, especially in an auction process where the timing is quite essential, because they will not be able to proceed as fast as EU investors, obviously. We will need, and the practice will develop clauses that take into account this procedure in terms of risk allocation, obviously conditions precedent, but also cooperation obligations between the target and the foreign investor, and possibly also a long stop date, because seen as the screening period is undetermined, there will come a moment where parties will want to have a deal certainty. So probably a sort of a long stop date, so a final cutoff date will also be included in transaction documents. It creates a lot of uncertainty. We don't know yet how the legislation will be interpreted and applied. There is room for interpretation, like I said. So the first deals that will be notified will be a bit the guinea pigs of FDI, I'm afraid. And then, the sanctions should also be taken into account in the transaction documents, and how to handle corrective measures that will need to be implemented, and probably also, like I said, some information obligation, because it's the foreign investor that has to do the filing and, let's say, conduct the whole assessment and screening with the Commission. But as targets and as sellers, of course, you would want to also be informed of the ongoing procedure and the measures that will be taken. So clearly, an important thing to keep in mind as from the 1st of July, but actually already now, when you're contemplating an investment by a non-EU investor. Then our second topic today in terms of corporate will be the impact of ESG on M&A and due diligence. So of course, you all know what is ESG. So it aims at incorporating a long-term sustainability in performance. So the E is for environment, the S is for social, so respect for human rights and working conditions, and the G is governance, so such as diversity in the boardroom, stakeholders, and anti-bribery policies. I'll very briefly present the main legislation that, in our view, has an impact on M&A and due diligence. I won't go into detail, but that will be the Green Deal, the EU taxonomy, everything relating to non-financial reporting, and then finally the CSDD. So what is the EU Green Deal? It dates from 2019, so it's a strategy of the European Commission to transition to a sustainable economic model with the aim of net zero greenhouse gas emissions and reaching climate neutrality by 2050. This is sort of the mother legislation for everything that is ESG related in Europe. So it will have an impact on all the businesses in Europe. The EU taxonomy, what is it? It's sort of the first green list of sustainable business activities. So it's a classification framework that establishes definitions and rules to qualify what are sustainable economic activities. So it's like a universal set of sustainability metrics that enables to compare between companies what are the various sustainable economic activities, and also to identify and direct investments towards sustainability projects and to fight the so-called greenwashing. The primary aim of the EU taxonomy is the financial sector, and it has 6 environmental objectives, such as climate change mitigation, transition to a circular economy, or pollution prevention, for example. Then we have the non-financial reporting directive, which applied as from 2017 already. So here The purpose is to impose reporting obligations regarding non-financial information, but that has to be included in the annual report of companies. The purpose is to enable an assessment of value creation and risks regarding sustainability. And so it encourages ESG responsibility in EU companies because they have to disclose their non-financial information in the annual report. The scope was mainly targeted at public interest entities, so very large companies, listed companies, banks, and insurance sector. So that was the main target. And this regulation, this directive, is now being replaced by the Corporate Sustainability Reporting Directive, which basically is an enhanced version of the previous directive. So it will basically extend the scope, because we will look not only at public interest companies, but we will basically look at EU companies that are large or mid-size. And we will also look at non-EU companies that have, let's say, a significant turnover in the EU. So that's the two, let's say, target group. It's a legislation that is going to enter into force as from financial year 2024, so next year. That is for the companies that were subject to the previous directive. And for the other companies, the entry into force is a bit scattered in the time. So it will be financial year 25, but then the mid-sized companies have the possibility to opt out until 2028. And non-EU companies will also have the possibility to wait until 2028. So that's the first aspect of the CSRD. It will increase the scope. There will be more companies that will need to apply it. And at the same time, it also increases the sustainability reporting itself. The purpose is to increase the transparency, the consistency, and the reliability for the stakeholders. So a scope that is broader in terms of companies concerned, and also the information to be reported on is also broader. And then the last directive I wanted to present before we talk about the impact of all of this on M&A is the Corporate Sustainability Due Diligence Directive, CSDDD. This is a proposal of directive, so it hasn't entered into force yet. What does it do? It imposes mandatory due diligence practices to identify, prevent, and mitigate adverse impacts of activities on human rights and the environment. So basically, companies that are in scope will need to carry out an internal due diligence on their own activities, but also on the activities of their business partners to ensure that they are compliant with human rights and environment. It has a broad applicability because it covers large companies, mid-sized companies as well that are active in high impact sectors. There we have it. And it will also apply to third country companies, so non-EU companies that have a significant turnover in the EU or that have a significant turnover in high impact sectors. We'll go back. So it hasn't been approved yet. And once it's approved, then the member states will still have 2 years to transpose it. But so that's the purpose of the CSDD. What are, I mentioned, high impact sectors. So those will be the textile, the agriculture, and the mineral resources sectors. And so that is where the focus is in terms of human rights and environment. The European Commission estimates that at least 13,000 companies in the EU will fall under the scope of this directive, and about 4,000 non-EU companies. So as I mentioned, what does the directive impose? So businesses have to conduct an HR and environmental due diligence on their activities and the activities of their business partners. This due diligence has to be integrated in the corporate policies, and the purpose is, of course, to identify adverse human rights or environmental impacts. Then, once that due diligence has been conducted, the purpose is to prevent and also to mitigate the impact on human rights and environmental, which means that it could also lead to the company having to terminate certain business relationships if the due diligence, the internal due diligence, has established that there's an issue in terms of human rights and environment, which at the moment, I would think that most contracts don't foresee for that possibility. So that will also be interesting to see how the practice will evolve in that respect. Then in the framework of this due diligence process, the companies in scope also need to set up a complaints procedure, monitor how the measures are implemented, and also has to communicate on such measures, and in particular have then an environmental action plan. So we've now talked about all these several ESG legislation. There are others, of course. You have also directives on sustainable financial products, for example. But all of this, what's the impact at the moment on M&A? First, for the businesses themselves, of course, they have new responsibilities. They have there's new legislation applicable. So that's on let's say the business side. But it also means that when you consider an acquisition, as a buyer, you will need to increase the level of due diligence that you do and to add an ESG part to your due diligence, which will need to be carried out by several advisors, because ESG is very broad. So there's a legal part, but there's maybe also a technical environmental part and things like that. So that's certainly the first and main impact, is to broaden the scope of your due diligence and to select the advisor who can help you, let's say, targeting the various aspects of ESG. Because, of course, we expect that in the future, if you don't do so as a buyer, you could have reputational damage. It could be bad for your investment as well on the long term. We would have to see then, for the issues that are being raised in the framework of that ESG due diligence, what do we do with it? And the identified issues or the risks, these could have an impact on the deal value. That's possible. As a buyer, you may ask that a certain non-compliant part is ring-fenced or carved out prior to the acquisition. So this will, of course, have an impact on your transaction documents. How will you factor in the risks that you have identified in your ESG due diligence? Is it going to be indemnification clauses? Is it going to be reps and warranties? Are you going to ask for certain closing obligations? Maybe for some matters that are of, let's say, less importance, you would go to post-closing obligations of the target. I mean, we would have to see, of course, depending on the gravity of the issues. Maybe some of them are deal breakers. So I think you will have the whole range of possibilities depending on the issues that have been identified. And then, of course, you will have to ensure, once you have acquired your target or invested in the target, you will have to ensure further compliance in the future so that you keep the value of your investment. So I think in terms of M&A, it will be mainly the scope of the due diligence and then the impact on the transaction documentation and on the negotiation, of course, with the sellers and the target. How to prepare? I think get as much information as possible on the applicability. Does the legislation apply or not? So a lot of due diligence as well, both internally for the targets, but also for the buyer. I would think also that in the future, if you recruit a new CEO or some people in the top management, that people will take knowledge of ESG legislation more into account when appointing new directors or management, because you will need to have someone on board who is aware of ESG regulation and policies, and who can also guide the target and ensure compliance in the future. And I would say, yeah, collect as much information as possible to facilitate the analysis of what are the regulations that are applicable to the business. So two very challenging, I think, developments in the framework of M&A. Thank you for your attention, and I will now leave the floor to my colleague Geert de Neef for the tax topics.
Good morning, everybody. Thank you for attending our webinar. I will now thank you very much, Florence, for this very interesting contribution. I will now focus on some tax topics which are, I think, relevant for the M&A, the venture capital and the private equity sector. It is so that the pure M&A is somehow somewhere in calmer waters these days, which is not unlogical given the economic climate. However, this leaves more room and I would say opportunity to structure one's investments for corporate executives, for investment funds, for banks, for anybody. I think it's relevant to consider from a tax point of view, what do we need to take into account at this moment? So I selected a couple of topics which have popped up during the last months in jurisprudence as well as in our own dossiers, and which I think may be of interest to you. So first we will discuss some tax rulings on private equity and corporate structuring, which have been issued by the Flemish tax authority. Then there are two cases out of the recent jurisprudential cases I would like to develop on. And then finally, I think, well, in politics, everything changes every day, but I want to, in any case, exchange some information with you where we stand with the planned tax reform, because next week, I believe next week, there is a gathering of the top ministers to consider that after all, which kind of tax reform do we want? There were some worrying first messages on this one, so worrying information, but I think we will need to place it in a more specific context. So now let's kick off. The Flemish tax authority has issued two rulings recently, Vlabel, on March 22, 2023. What is actually the context of the rulings? Well, inheriting, if one inherits shares of a company, an individual who lives in the Flemish region and he inherits shares in a company that is subject to a significant inheritance tax. The rates are going from 27% already as of 250,000 to even 55% for third parties, which rate applies even as of 75,000 euros. Now, of course, estate planning is simple in that sense that if you donate shares, if they leave your assets, they will leave your assets finally from a tax perspective. If you do a pure donation, a gift, which you subject to a gift tax, you pay 3% or 7%. If you donate those shares to your loved ones, to your children, to your partner, to whoever you care for, you can pay 3% in a direct line or to your partner, or 7% to anybody else. As of the moment that the gift tax is paid, the assets have left your taxable basis. Of course, the problem is once you have given, it has disappeared. You don't always want to give assets if you do not know yet how long you will live, or if you will never regret it or whatever. There are certain conditions that you can attach to a gift or a donation you make. The problem is, even with these conditions, you have a kind of a marginal control on the compliance of these conditions, but once the gift is executed, along with the conditions, well, it has left your portfolio, your private asset portfolio, and the only action you can take is, well, the only action left is a kind of a judicial action, which is not always a conflictuous model you want. So therefore, there are various tools to assure that you can still have a kind of control and at the same time transfer assets. That's why more and more partnerships are used, maatschappen in Dutch. Partnerships are used to structure such asset transfer to the next generation, and at the same time controlling a certain type of control. So there are two rulings which we will discuss here and after. The rulings are more or less similar in the way that they allow a gift tax-free transfer of assets to the children of the settler of the structure of the partnership of the maatschap. So in the first ruling, there was a contribution for the benefit of a third party. What does it mean? That company shares are contributed by the main partner, the settler of the structure, the father of the children who are also partner in the partnership. So these shares are contributed to a partnership. The shares issued by the partnership to remunerate, to compensate the contribution, normally would be attributed to the person who contributes, the one who brings the shares, who pours the share into the partnership. But in this case, the shares that the partnership issues as a remuneration were issued directly to the beneficiaries, so to the partner, to the principal partner's children. So this, at the same time, there is an addendum to the gift deed established and signed between all parties. Also, the partnership is a party to that additional pact. And in this additional pact, certain, I would say, legal competencies, authorities are defined. So there is a substantial power attributed to the principal partner of the partnership, but I would say the more passive partners, the children, still have to give their green light on certain decisions which are taken, like certain types of mortgages, certain transactions, the importance of which exceeds 1.5 million euros, etc. This is a way of creating a joint management, a joint decision model on the partnership, and it also allows VLABEL, so the Flemish Tax Authority, to issue a favorable ruling, because in the past they decided in a negative manner on certain partnership models, because all the power there was concentrated in one person, the manager of the partnership, which was also the settler, the father, or the grandfather, and whatever. So to avoid such negative ruling here, there is a shift in authority on the management of the partnership. So VLABEL decided to give this type of partnership a green light. Then there is also another tax ruling which should be interpreted in the same context. It's a tax ruling whereby there is a contribution in a partnership, but without the issuing of new shares. What do we have here? We have the same context. So we have a family, we have a settler of a partnership, a maatschap in Dutch. And at the moment that the partnership is finally structured or incorporated, the children are already gifted or already did receive a substantial amount of the shares of the partnership. However, at a certain moment, a very substantial contribution is made into the partnership by the settler of the partnership, the main partner, the father, but the partnership does not issue any new shares. So everything remains as it is. The children each have, I think, 40–45%. The father has 10%. The father contributes an important stockage of shares, participation of shares into the partnership. But the partnership does not issue any new shares. That means that the value of this contribution is for the main part actually attributed, transferred to the children who already have a major stake, a large majority in the partnership. Also here, VLABEL has decided this is not a transaction which triggers gift tax. It is a transaction which is acceptable, and it is acceptable for family and business purposes. So the only Vlabel concludes that tax motive is not the only valuable motive. There is a tax motive present, but as such, as long as there is also another motive than a tax motive present, this leads Vlabel to issue a favorable ruling. So some takeaways on these two rulings. Well, the registration of the transaction, which will trigger gift tax of 3% or 7%. There is no obligation to register this transaction, the setup of the partnership, because Vlabel has given a green light. However, even with this green light of Vlabel, the shares which are still owned by the main partner of the partnership, the settler, the father, if you want these shares to have them definitely disappeared from the inheritance, then it is recommended to make an additional donation and subject this to the 3% gift tax or 7% gift tax if third parties are involved, because the green light of Vlabel means that the transaction as such is not subject, the entire structure is not subject to gift tax, but the shares that remain out of the structure in the hands, in the ownership of the settler, they of course remain in his taxable basis for inheritance tax purposes, and to make these assets disappear, we still will need to apply the gift tax. It's important each time to have a business or a family planning motive. This is essential to avoid the presence of tax abuse, and the beneficiaries need to maintain a relevant control or legal authority of the structure. Otherwise, Vlabel will consider that there is no change of control over the assets, and therefore it will be considered as non-opposable from a tax point of view. Then there are two jurisprudential cases I would like to discuss with you. One of them is a recent one of January 3 of the Court of Appeal of Ghent. And what is decided there, this is important, I think, when you structure a private equity deal, a venture capital transaction, or a personal restructuring of your business. The Court of Appeal of Ghent has decided that tax authorities are not authorized to apply the tax avoidance principle as expressed in Article 344, so the anti-abuse rule, which allows them to impose a tax on a different situation because the situation presented by the taxpayer is not accepted by the tax authorities. So they cannot apply the anti-abuse rule if they change the facts of the case at hand. They need to accept the facts unless they demonstrate that it's simulative behavior. So they need to accept the facts as they are, insofar, of course, that these facts are sincere. So the court's decision imposes clear boundaries on the tax authorities' right to challenge the freedom that taxpayers have to structure their transaction in a tax-efficient manner. So it remains allowed to structure your transaction in the way that you deem fit. You can choose the most tax optimal way of formalizing whatever deal, whatever transaction you conclude. Now, perhaps to look at the facts here. It was an international private equity restructuring scheme in which a Belgian individual acquired for one group company shares in another group company. So he became owner of those shares. He was also professionally active in the group of companies concerned. The individual also incorporated a Dutch foundation, which at its turn, then incorporated a Luxembourg investment company. So the individual, he bought shares of a company group, of a group company. He incorporated a Dutch foundation, which then incorporated a Luxembourg investment company. The shares that the individual acquired, he then sold these shares to the Dutch foundation, which sold the shares to the Luxembourg investment company. And finally, the Luxembourg investment company, sometime later, sold the shares with a substantial capital gain to a third party. So it was a chain of sales of group company shares, which were undertaken by the individual and by the companies that he established. The tax authorities considered actually what the Belgian tax authority said, listen, this entire chain of companies, for us, it's not opposable. We looked through it, and what we will do by applying Article 344, the anti-abuse rule, we will say that the final sale of shares, which was undertaken by the Luxembourg company, was actually done by ourselves. So we will tax you personally as an individual, as if you were the one who did the final sale out of Luxembourg, but you are in Belgium taxable on your worldwide income, and we will tax this as a professional income. The court ruled in favor of the taxpayer because they said this conversion of facts, the tax authorities are not allowed to proceed with that. They cannot ignore the existence of the various sales of share that intervened. They cannot neglect the existence of the various companies, foundations, and investment company, etc. And for that reason, they also actually debunked the tax authorities' point of view, and they cancelled the tax assessment that was issued to the individual. This court's judgment once more confirms the obligation that the tax authorities have to respect the facts as they are presented. It is only when there is a frustration of the law, so there is a clear violation of a specific rule of law, like neglecting the existence of companies, etc., and there is an established intent to avoid taxes, that should be the prime and as good as the only motive for the transaction, for the restructuring. In such situation, they can apply Article 344. If they fail to deliver that proof, they cannot apply Article 344D, that means the tax authorities. There is another case which unfortunately went a bit less positive for the taxpayer. That is the Court of Appeal of Antwerp of September 6, 2022. What is there the case? It was a private equity transaction where an individual and his son who had companies in the telecom sector were involved. The facts are a little bit complicated, but they are here in a summarized way, I think clearly explained. So father and son, they had shares in various companies in the telecom sector. These shares were owned by the individual and son. There was a complex series of restructuring operations. The individual sells an important part of his shares in company A to a third party, so to the investment fund, the private equity firm. And the other 51% of the shares he sells to his son. So after this transaction, the individual is no longer a shareholder of company A. What happens then? Well, immediately after those sales to his son and to the private equity fund, the individual sells all his shares in another company, company B, to company A. So the company that he had, company A, buys from the individual, company B. The sales price is 14 million and a little bit, well, a little bit 300,000 euros. It's not a little bit, 14,300,000 euros. And company A, who buys the shares of company B, concludes a bank loan to finance the acquisition together with a credit facility. Then company A, they pay the individual who sold them the company B shares. And company B then, company A then, who paid the individual, repays the bank via a loan it receives from company C. Company C is a subsidiary of company B. So the shares of company B are sold to company A. A goes to the bank, takes a loan, pays the individual, and then gets a loan from the subsidiary of company B to pay back the bank. How can company C pay that, make that loan? Well, because company C has a lot of cash. If this cash would be distributed to the individual, well, first to the parent company, to company B, and from company B to the individual, assuming he had not sold the shares of company B, it would trigger 30% withholding tax. Nobody likes to pay 30% withholding tax. So what did the individual do? He sold the shares of company B to company A, realizing a capital gain which he considers tax exempt. And in such respect, he avoids paying the 30% withholding tax. After the transaction, the 30% withholding tax becomes irrelevant because between connected companies, there is an exemption for withholding tax. So when company A is to receive in a later stage a dividend distributed, any dividend distributed by company C, at that moment an exemption would apply. So this is what happened. Later on, company B and C are merged into one company, and then company A, who still has a debt towards company C, actually compensates that debt because company C distributes a dividend in kind, meaning the claim. So there is a reunion of claim and debt at the same level, so there is actually no taxation due. It's a relatively simple scheme, and with the final result that the individual has realized a tax-exempt capital gain on his shares. The tax authorities are not impressed, and they say, listen, this entire setup is done only for the reason that you want to avoid withholding tax, because you have violated Article 18 of the Income Tax Code, which provides for a taxable dividend. What is a taxable dividend income? You have avoided the application of that article. Also, the fact that third parties, the investment fund, were actively involved in the restructuring, for us is irrelevant. What you should have done, that's actually what they say, you should have distributed the dividend like any normal shareholder would have done before selling the companies. It is a bit surprising that the tax authorities did not consider this road, because it's not an easy road applying Article 344. They could also have said, listen, the sale of these shares in such a context actually constitutes a miscellaneous income, a speculative income, a divers inkomen, which is taxable at the rate of 33%. No, they went for the dividend income, which is taxable only at 25%. So they took, I would say, the longer road, instead of trying to go for the miscellaneous income. Probably that's also because the father already had the shares for a very long time, and in such a case it's not easy to prove that actually miscellaneous income is present. So what did the court rule? Well, the court rules in favor of the tax authorities because they say that the entire series of transactions clearly has resulted in a financial impoverishment of company C, which has spent all its cash reserves by granting a loan to pay back the sale of shares. Company C indeed did obtain an intra-group claim as a result of the loan granted to company A. Company A needed to pay the individual, but this claim was on a later stage distributed to company A as a dividend. Well, I would say an impoverishment always takes place when you distribute a dividend, but here it was done in a very aggressive manner. The series of transactions is considered as having one single purpose, so even if various transactions are concerned, it is considered as one single purpose, eenheid van opzet. And then this is, of course, to the disadvantage of the taxpayer, very negative element. It was demonstrated on the basis of certain mails which were discovered by the tax authorities that all parties considered as a main motive the tax opportunity of restructuring. So there was no real business motive delivered during or after the restructuring. Also, as I just mentioned, the post-restructuring actions as well failed to deliver any business motive. So it means that a business motive indeed is very important. Here, the financing, the restructuring, the merger, the sale of shares, everything was driven by one single motive, avoiding the 30% withholding tax in case a dividend would have been distributed. So one can wonder why actually all these transactions happened shortly before the sale of the shares to the private equity fund and to the son. Probably it was a kind of a pre-financing issue they wanted to avoid. So by doing this, they considered that they made the transaction way more flexible and easy to happen and to finalize. But of course, they took on board a tax risk, which at this moment has costed 25% plus a fine, I believe, of 10% on the deemed dividend on the 14 million, which is still, well, an expensive ticket of 3.5 million to pay on additional taxes. Then some final words in order to remain within the time schedule. So what did the Minister of Finance propose? It's all mentioned here on the tax slides, on the slides of our presentation. You can also download the slides, or if you wish that we send them, we will be glad to do so. So what they actually want to do is the present dividend deduction regime, which provides for a 100% tax-free freedom by providing a reduction. They want to make this into an exemption, which will have the result that, for instance, DRD credits which result after a specific tax year can no longer be transferred to subsequent tax year. The conditions for applying the present tax exemption on capital gains and on dividends are listed on the slide there. So you need a 100%, you need at least 10% ownership for a minimum acquisition value or a minimum acquisition value of 2.5 million during a non-interrupted period of at least 1 year. What the minister wants to change is that so it will become a tax exemption instead of a tax deduction. I'm going swiftly to the main change proposed, that he wants to adapt the minimum participation condition when the holding does not reach 10% but still has a minimum acquisition value of 2.5 million. Such participation should have the nature of a financial fixed asset. So that means that there are certain conditions which need to be fulfilled. These conditions, when do you have a financial fixed asset, are mentioned on this slide. You will be able to read it. What does the minister actually wants to target? He wants to target situations whereby shares are held by corporate taxpayer as a pure investment. So when you do not reach the 10% threshold, but you do reach the 2.5 million euro investment, at such a moment you will need to establish that the participation concerned qualifies as a financial fixed asset, which is not that easy because it needs to be indeed a connected company, which requires a long-lasting relationship, and also it needs to be a durable relationship, which means that there is a positive effect on the management has a positive effect on the value of the companies concerned. So this may lead to quite some substantial disputes with the tax authorities, these conditions. It is not certain, that's why I will not develop too much on it. It is not certain that this final proposal will be accepted by the government and by the parliament, because there has been a huge resistance in the private equity sector that if these conditions would apply on participations below 10%, even with a ticket of 2.5, otherwise it's a full taxation if the 2.5 condition is not fulfilled, that this transaction, that these conditions may urge many private equity players who are still Belgian-based or who have a company, a Belgian-based company, will disappear and will look to other countries such as the Netherlands, Luxembourg, even the UK or other countries who still have a more private equity and venture capital friendly approach. So it's exactly 12.30 now. That means that our limit is well, eliminate respected. I hope this webinar was useful for you. I welcome any questions you may have. Please forward them. You will also be able to download the slides, or we will send the slides to you if it would not be possible or not easy possible to download the slides. We thank you very much for your attention, Florence and me and myself, and we are looking much forward to welcome you on one of our next webinars or seminars. So have a good day, until very soon.